Hey friends, Loss Ratio here. This is me talking about insurance while I try to catch a fish. So I want to talk a little bit about what's going on specifically in the underwriting inspection space. There are some really interesting dynamics taking place right now. Obviously, if you've been following me for any length of time, you know that my thing is self-inspection. I am convinced that this is absolutely the future of property assessments for underwriting purposes. But I want to share a little bit more context, kind of what's going on behind the scenes in the industry and is really driving this shift towards self-inspection and away from the way that things have been done for the past 5+ decades in terms of sending inspectors out to properties, boots on the ground, to complete these property risk assessments. So for many decades, many property carriers have traditionally contracted with third-party vendors, inspection firms, like the firm that I'm the president of, to send inspectors out to properties and conduct some exterior only inspections, sometimes interior inspections, high value assessments, and everything in between. And carriers have relied on these third-party assessments to ensure that the risks that they're writing conform to their underwriting guidelines, that it fits within their appetite, ensure that there aren't any major liability hazards on a property, pre-existing damage on a property that could turn into a fraudulent claim, as well as verifying replacement cost valuation figures and ensuring that the coverage A amount that they've bound on the policy is accurate for the structure that's there. And while there are a small number of carriers that have handled this process themselves in-house with employee inspectors, the vast majority of these property assessments, as I mentioned earlier, have been conducted historically by third-party inspection vendors. And many millions of these property assessments are taking place every single year across the country. Carriers collectively spend hundreds of millions of dollars annually on these property assessments. So what's changed? What are the dynamics at play here? Now, the vast majority of these third-party inspection firms utilize independent contractor inspectors. So this is a 1099 model. The inspectors who are actually out in the field doing the work are independent contractors. They're 1099s. They're not employees of the inspection firm. There are a couple exceptions to that, but again, the vast majority of inspection firms and inspections are being completed by independent contractors. And that factor has more or less kind of set the standard for what carriers are willing to pay for these assessments and what they have historically grown accustomed to paying. Like any large organization that is managing lots of vendors that are providing products and services, carriers typically go through an annual RFP process, asking for proposals from all of the big inspection firms. Generally speaking, whichever firm comes back with the lowest pricing is going to get the contract. And while this certainly makes sense from the perspective of a carrier ensuring that they're getting the most bang for their buck and ultimately controlling their underwriting expense, it also does, unfortunately, create that inevitable race to the bottom among vendors, especially with the large Tier 1 carriers. These are very large contracts, many millions of dollars annually. Those are obviously very valuable contracts to the inspection vendors.
Franklin, Grant, and Jackson.
So let's talk about what's changing. There are really a handful of factors that are kind of totally rewriting the rules here and upending the game when it comes to underwriting inspections. And the first one is no secret. It's literally just economy, inflation. As the economy has evolved, especially through COVID, there was a lot of expense pressure placed on inspection firms in a very short amount of time. When you have inspectors who are collectively logging millions of miles, traveling to these properties to inspect, completing millions of inspections, and you have fuel prices going up 40-50% in some places through COVID, that creates an immense amount of pressure. And so obviously when inspectors are paying 50% more for their fuel, they're obviously going to be demanding much more money to account for that from the inspection vendors that they're working for. Problem is, inspection vendors are locked into 1, 2, sometimes even 3-year contracts with carriers. They don't have the ability to raise their prices to account for these increased costs. So inspectors are demanding more money, rightfully so. Their expenses have gone up dramatically. And we're not talking about just fuel. Obviously, we've all experienced general inflation and living expense increases through COVID and continuing through to today. I don't blame the independent contractor inspectors at all. They're just trying to feed their family and put food on the table.
Just want to eat.
But this has put an immense amount of financial pressure on the inspection firms who ultimately are providing these services to carriers. And so because of all this financial pressure, especially through COVID, a lot of independent contractor inspectors who were completing so much of this work for inspection vendors and ultimately for carriers, they said, hey, this just isn't worth it anymore. And they threw in the towel, they hung up their proverbial measuring wheel and said, I'm not inspecting anymore, I'm going to go into a different line of work. So the available pool of inspection talent out in the field has shrunk dramatically over the last 3 to 5 years. And so this has only added more pressure to the process as inspection firms are scrambling, trying to get inspector coverage across the country so that they can fulfill their contract obligations with their carrier clients. At the same time, as there are way fewer inspectors out in the field, the inspectors that have stuck around and are left, they're beginning to understand their value. They know that the inspection vendors that they're working for absolutely have to have them. They're raising their prices as well and demanding even more money than they ever have. And again, I don't necessarily fault them for that supply and demand. So now as we've, knock on wood, come out of COVID and these large inspection contracts have been coming up for renewal with carriers, inspection firms have had to take a harder look than ever at their financial structure and figure out if we're going to lock ourselves into another year or 2-year or 3-year contract, there is more uncertainty than there has ever been historically around what these inspection costs are going to look like. And so to account for the current economic variables as well as future risk, inspection vendors have raised their prices significantly over the last few years. Generally speaking, anywhere from 20 to 40%. And this obviously has increased underwriting expense for the carriers significantly. And perhaps now more than ever, increasing expenses for underwriting has been a really tough pill to swallow, especially given the personal lines underwriting performance of most carriers over the past few years. It has been really tough to turn an underwriting profit. Property loss ratios and ultimately combined ratios have been a huge challenge for carriers. So here's the volatile combination in the powder keg. We've got fewer inspectors than ever out in the field to do the work, which means they're demanding more money than ever to complete inspections. You have inspection vendors raising their inspection prices to carriers exponentially, and carriers facing that added underwriting expense pressure. At the same time, carriers are looking at their loss ratios and realizing that more thorough and comprehensive underwriting is desperately needed, so they need these inspections more than they ever have. So what's the solution? What is the answer to all of this? Well, like most things in insurance, there's certainly no silver bullet. There's no single puzzle piece that solves the entire equation. However, there are solutions that can have a massive impact. Obviously, the one that I'm the most excited about is self-inspection. It relieves so much of this pressure in so many different ways and adds additional value to the process that was never there before. So on the financial side of things, obviously, self-inspection removes that third-party inspector from the equation and thereby drastically reduces traditional expenses for that inspection. And the biggest question that pops up into everyone's mind, and is a very valid question, is, okay, what are carriers losing out on? What is the downside of self-inspection compared to sending a third-party inspector out to a property? And believe it or not, the answer is not really much at all. And if you do a true side-by-side analysis of self-inspection versus field inspection, there really is no comparison. The pros of self-inspection far outweigh the cons. It really is just a no-brainer. And I gotta say, I have never been more excited to be smack dab in the middle of an evolution like this that is having such a massive impact on underwriting. Company I'm the president of, NIIS, we quite fortuitously were a little bit ahead of the curve. We had built out our self-inspection product and platform pre-COVID, before all of this craziness happened. And so when COVID hit, we were ready to hit the ground running. And self-inspection exploded through COVID, and the momentum has not let up. This is the future of property inspections, and there's no stopping it now. So thanks for following along. If you have questions or thoughts or comments, I'd love to hear them. Do you agree, disagree? Let me know. And now I got to get serious and try to catch a fish.
It's a hard market now. What you gonna do? You got reinsurance issues, LOC from best to your capacity is shrinking, paper going up in smoke, combined ratio is climbing, and that